A massive, completely unexpected miss in the U.S. jobs report just sent an absolute shockwave through the global economy.
Oh, yeah, it really did.
And the immediate reaction, gold just snapped a 4-week losing streak, surging right past $4,160 an ounce, while silver rocketed to $62.80.
Which is just a staggering move for a single day.
Exactly. But before we get into the weeds of why this is happening, please take a second to hit that like button, subscribe to the channel, and drop a comment down below with your opinion on what we talk about today. We love hearing from you, and it really helps out the deep dive.
It absolutely does.
So welcome to a brand new deep dive. Today, we are analyzing a seismic mid-year shift that's happening right now in the global precious metals market as of July 4th, 2026.
And, the velocity of this market pivot is just, well, it's staggering. We are moving from a multi-week period of heavy selling straight into a vertical price spike.
Right.
And it is entirely driven by these shifting macroeconomic expectations.
So to map out exactly what is happening for you, we are synthesizing 3 major financial bulletins today. We've got the Global Precious Metals Market Analysis, the Gold and Global Market Outlook, and the July 4th Gold and Silver Market Analysis.
That's a lot of data to chew through.
It is, which is why our mission here is to strip away all that dense financial jargon. We want to figure out the exact mechanisms driving this sudden price explosion.
Right, because if you just look at the surface level price action, you're going to get whiplash.
Oh, Dad.
You really have to understand the underlying data that triggered the algorithms and the institutional buyers.
So let's dive right into that trigger. The culprit for this massive market reversal was the June U.S. non-farm payrolls report.
Yes, the jobs report.
The consensus on Wall Street was that the U.S. economy would add about 110,000 new jobs.
Which is a fairly standard expectation.
Right. But the actual number came in at a measly 57,000.
It's just a staggering underperformance.
Yeah.
I mean, missing expectations by nearly 50% is incredibly rare.
Yeah, it's a huge miss.
But the headline number is actually just the tip of the iceberg here. The more concerning metric, the one that really forced the market to abruptly reprice gold that was hidden in the revisions.
Oh, the backward-looking data.
Exactly. The Bureau of Labor Statistics quietly revised the previous 2 months downward by a combined 74,000 jobs.
Wait, so which means the whole narrative of a resilient labor market in April and May was, it was fundamentally flawed.
Completely flawed.
We weren't just experiencing a weak June. We were looking at a systemic, multi-month deterioration that the market was just completely blind to previously.
Precisely. And when you compound those downward revisions with the fact that the labor force participation rate just hit a 5-year low, you're looking at undeniable evidence of economic cooling.
Right.
The labor pool is shrinking and job creation is stalling at the exact same time.
I want to look closely at the immediate market reaction here, because the speed of it tells us a lot about how institutional money was positioned.
Oh, it was violently fast.
Yeah, gold didn't just drift higher, it aggressively broke its losing streak. It blew past $4,160 and made this hard run at the $4,200 an ounce threshold before it finally settled for the weekend at $4,175.
And silver acted like gold on leverage, honestly.
Right. Silver jumped to $62.80 an ounce before closing at $62.40.
Yeah, silver generally has a much higher beta than gold.
Meaning it's more volatile.
Exactly.
Yeah.
Because it has a smaller market capitalization and it has dual industrial use, any macroeconomic catalyst that moves gold will typically move silver much more aggressively in percentage terms.
Okay, let's unpack this for a second because I want to look at this logically.
Sure.
If the economy is doing significantly worse, right, fewer people have jobs and the labor force is shrinking, shouldn't shiny metals be less valuable?
It seems like they should be, yeah.
Like if consumer health is deteriorating, the average person has less discretionary capital to, buy a gold coin or jewelry.
Right.
Why does bad economic news create a massive surge in the price?
Well, that is the paradox of safe haven assets. And it really highlights the difference between the physical retail market and the institutional paper market.
Okay.
This price spike isn't driven by everyday consumers going out and buying physical metal. It's driven entirely by institutional capital front-running the Federal Reserve.
Oh, I see. Because bad economic news forces the Fed's hand.
Exactly.
If the economy is naturally cooling down, as we just saw with this massive 57,000 jobs print, The Fed no longer needs to aggressively suppress demand with high interest rates.
Right. The market instantly looked at that jobs data, and they retraced the probability of rate cuts, specifically targeting the September Fed meeting.
So institutions began placing massive bets that the era of tight monetary policy is ending a lot sooner than expected.
That's exactly it. And that expectation of lower interest rates triggers this massive macro domino effect.
Let's talk about those dominoes, because the first domino to fall is the currency itself, right?
Yes, the U.S. dollar index.
The index dropped to near a 2-week low, closing at 100.879. And since gold is universally priced in dollars, a weaker dollar mechanically makes gold cheaper for anyone holding euros, yen, or yuan.
Which instantly boosts global demand.
Right.
But, the more significant domino is actually the bond market. Following that jobs report, U.S. Treasury yields dropped sharply down to 4.485%.
This relationship between bond yields and gold is arguably the most important mechanism in the entire market.
It really is.
Think of holding a treasury, like having a savings account that pays you a guaranteed yield.
Right, you get paid just for holding it.
Exactly. Holding a physical bar of gold, conversely, pays you absolutely zero interest.
It just sits in a vault.
Right. So when bond yields are high, say, paying out 5%, holding that gold bar comes with a massive opportunity cost. You are actively sacrificing that guaranteed 5% return.
And institutional fund managers cannot afford to sacrifice yield. They are mandated to chase returns for their clients.
Exactly. But when those bond yields suddenly drop to 4.485%, with the market pricing in even further declines because of expected Fed cuts, that opportunity cost shrinks.
It shrinks dramatically.
Suddenly, giving up that guaranteed yield doesn't sting quite as much. That zero-yield bar of gold transforms from a dead asset into a highly attractive portfolio insurance policy against, currency debasement.
That mechanical relationship right there is the engine of the paper gold market.
Okay.
But our sources highlight another crucial factor here that often gets overlooked, and it actually acts as an accelerator for everything we just discussed.
What's that?
We need to look at the energy markets. Oil.
I was wondering how the petroleum data fit into this picture. We're looking at WTI crude sitting low at $68.97 7 barrel, and Brent crude at $71.93.
Right.
My initial thought was that a slowing economy means less demand for oil, which explains the price drop. But how does cheap oil act as a catalyst for a gold rally?
It all comes down to structural inflation. Energy is the foundational input cost for the entire global economy, right? Yeah, it powers everything.
Exactly. It dictates the cost of manufacturing, agriculture, shipping, all of it. When oil stays subdued in the high 60s and low 70s, it acts as a massive anchor on overall inflation.
Because it's just plain cheaper to fuel the logistics networks and power the factories.
Spot on. And our sources point out that there is significant geopolitical pressure keeping those prices low right now.
Oh, really?
Yeah, there are ongoing efforts to secure maritime circulation in the Middle East, seeking alternatives to the Strait of Hormuz, and advancing negotiations with Iran. As long as those oil prices stay suppressed, inflation is essentially mathematically capped.
And sustained low inflation gives the Federal Reserve the ultimate unhindered green light to cut interest rates.
You've got it.
So low oil gives the Fed permission to cut, which lowers bond yields, which drops the dollar, which spikes the price of gold. It is just a highly interconnected web. It is entirely interconnected. But, and this is a big but, we have to recognize that everything we've discussed so far, the jobs data, the bond yields, the Fed expectations, that is all paper market dynamics.
Right.
That is Wall Street trading derivatives and futures contracts based on, algorithmic models.
Which really dictates the short-term volatility. But if you want to understand the long-term structural floor under this market, we have to look at the physical movement of the metal.
Exactly.
So who is actually taking delivery of physical gold bars while Wall Street plays with paper contracts?
And the answer is sovereign states.
Central banks.
Yes. According to the latest data from the World Gold Council that's highlighted in our sources, central banks quietly accumulated another 41 tons of physical gold in May alone.
41 tons in a single month. That is an immense amount of capital flowing into a zero-yield asset.
It really is. And it is part of a deliberate multi-year strategy of de-dollarization.
Right.
Central banks, particularly in the East, are realizing the inherent risk of holding their sovereign wealth in U.S. treasuries.
Because a treasury bond is ultimately a liability of the United States government.
Exactly. It carries counterparty risk. And as we've seen globally, those assets can be frozen or they can be sanctioned.
Whereas a physical ton of gold stored in a sovereign vault in your own country has absolutely zero counterparty risk.
None.
No foreign government can freeze a physical gold bar that you hold. So this 41-ton purchase isn't a trade, it's a structural reallocation of national wealth.
Precisely. This relentless sovereign accumulation is completely price agnostic. They aren't trying to time the market based on a bad U.S. jobs report. They are buying regardless of the spot price.
And that creates a floor.
A massive fundamental floor that prevents the market from collapsing during periods of heavy paper selling.
And looking at the consumer level in the East, the sources point out a really fascinating divergence between the two largest gold-buying demographics on the entire planet, India and China.
The dynamic there is really shifting.
In India, right now, the high prices have successfully destroyed demand. Local buyers are just balking at the cost. We're in the seasonal off-peak period, and local jewelers are heavily pulling back on their inventory.
Yeah, it's a textbook reaction to price elasticity. When the price goes up, people buy less. But China is reacting entirely differently.
Right. Despite these near-record high prices, physical demand in China is actually showing signs of slight improvement.
Which is counterintuitive.
It is, but the data indicates that domestic prices in China have finally aligned closer to international spot prices. That premium narrowing has actually encouraged buyers there to step back into the market.
So you have this triad of activity. Indian buyers pausing, Chinese buyers returning, and central banks just relentlessly vacuuming up supply.
When you synthesize that structural physical demand with the paper market tailwinds we talked about, dropping bond yields, the institutional forecasts become highly aggressive.
They do. JP Morgan recently adjusted their models based on this exact convergence.
The sources outline those new JP Morgan projections, and they are eye-opening. They're forecasting gold to average $4,300 an ounce in the third quarter of 2026.
Right.
And then to hit $4,500 an ounce in the fourth quarter. And for silver, they projected oscillating between $65 an ounce for the remainder of the year.
It is definitely worth noting that they did adjust their near-term targets down slightly from their previous models, mostly due to some fractional weakness in immediate physical demand. But their long-term bullish outlook remains deeply entrenched.
Okay, $4,300 in Q3 and $4,500 in Q4 paints a very rosy picture.
Very rosy.
But if we pull back to today's reality, gold is not at $4,500. It's sitting at $4,175, and it is staring down a massive structural roadblock at $4,200.
Yeah, the $4,200 level is what technical analysts call heavy resistance.
I always look at these round psychological numbers acting as ceilings, and I assume it just comes down to institutional mechanics, like a boss fight in a video game.
A boss fight is a great way to think about it.
Right. It's not an invisible force field, it's just that large trading desks and algorithms have pre-programmed limit orders set to dump their holdings and take profits the exact second the price touches a clean round number, like $4,200.
Exactly. It's a sudden flood of supply hitting the market all at once.
That is exactly how it functions. When the price surged on the back of the weak jobs report, it sprinted right up to that $4,200 line. But the buying pressure simply wasn't strong enough to absorb the massive wall of preset sell orders.
The buyers became exhausted.
Profit-taking took over, and the price was rejected, forcing it to close the week lower.
And our sources explicitly warn that following this sudden spike, the market is currently in an oversold state.
Which sounds completely counterintuitive if the price just went up.
It does sound weird, but it refers to the broader context. Before this one-day spike, gold had been grinding lower for 4 consecutive weeks.
Okay.
The market had been aggressively pushed down by sellers. So this violent upward move is partly a technical bounce, a snapback reaction to that prolonged downward pressure ignited by the jobs data.
Which means one terrible jobs report does not guarantee a permanent, uninterrupted bull run straight to $4,500.
Not at all. It's a catalyst, but it's not the final word.
So what is the final word?
The real deciders, the data points that will determine if gold actually has the momentum to chew through that $4,200 supply wall, well, they're coming later in July and August.
You're talking about inflation.
Exactly. The market is entirely focused on the upcoming CPI and PCE inflation reports.
These two reports are going to heavily dictate the Fed's next move, and our sources map out 2 very distinct scenarios based on what those inflation numbers look like. So let's look at the bull case first.
Right. So if the incoming CPI and PCE data prove that inflation is consistently dropping, validating the narrative that cheap oil and a weakening labor market are in fact cooling the economy, then the thesis is confirmed.
The Fed can cut.
Yes. The Federal Reserve has the data it needs to ease policy without fear of reigniting inflation. In that scenario, institutional buyers will flood the market, easily absorbing those sell orders at $4,200.
And the sources target a breakout range between $4,240 and $4,280 an ounce in the near term for that scenario.
Right. But the bear case is equally plausible.
What happens if inflation unexpectedly spikes?
Well, if the data shows prices heating back up, the entire dovish narrative completely collapses. The Fed will be forced to maintain high interest rates to combat the rising prices, completely ignoring the weak 57,000 jobs print.
Ouch. In that scenario, bond yields would instantly shoot back up, the opportunity cost of holding gold would skyrocket, and the price could easily be rejected violently at $4,200.
We could see it plunging back down to $4,000 or even lower.
That is a massive amount of volatility hanging on two impending economic reports. But even in that bear scenario, even if gold plummets to $4,000, the experts and the sources emphasize that the macro foundation still remains solid.
Yes. Short-term paper market volatility does not alter the long-term structural realities.
Because we are currently navigating a world burdened by unprecedented global public debt.
Debt that mathematically restricts how high central banks can raise rates without basically bankrupting their own governments.
Plus, we have escalating, persistent geopolitical conflicts.
And we have that ongoing structural de-dollarization driven by sovereign nations buying 41 tons of physical metal a month. A hot CPI print in July just doesn't erase any of those macro forces.
So, bridging the gap between high-level macroeconomic theory and your actual portfolio, what does this all mean for your investment strategy right now? How do you actually navigate a market caught between a weak jobs report and an impending inflation data release?
Well, the sources are remarkably aligned on the actionable strategy for this specific environment.
Okay, let's hear it.
The paramount rule is to eliminate emotional trading. Absolutely no FOMO.
Fear of missing out. It is definitely the fastest way to destroy capital.
Absolutely.
When you see a massive spike like we just witnessed on a Friday afternoon, the immediate instinct is to chase it. You want to buy at the top because you think it's running away without you. And equally, when it dips, the instinct is to panic sell.
And to counteract that emotion, the sources recommend a strict adherence to dollar cost averaging, or what some folks refer to as bin quan jia.
Right. Instead of taking a lump sum and trying to perfectly time the market right before the CPI data drops, you deploy your capital in smaller, consistent tranches on a regular schedule.
Exactly.
Because if the inflation data is cool and the price breaks $4,200, excellent, your earlier tranches have appreciated. If the data comes in hot and gold plummets down to $4,000, equally excellent, your next scheduled tranche buys into the asset at a steep discount, lowering your overall cost basis.
It just mechanically removes the anxiety of trying to predict the future.
It smooths out the volatility curve.
It does. And while you execute that strategy, you need to make sure you monitor the correct leading indicators. Do not just stare at the price of gold.
Right. You need to watch the U.S. dollar index, track the movements of the U.S. Treasury yields, and pay very close attention to the rhetoric coming from Federal Reserve officials over the coming weeks.
And if you are looking at technical levels, the sources identify a very specific support band. The $4,130 to $4,150 range is essentially the floor for this current trend.
So as long as the price holds above that zone during any pullbacks, the broader recovery momentum remains intact.
That's the consensus, yes.
Now, I want to pivot to a very specific warning included in these reports, which is honestly incredibly refreshing to see in financial analysis.
Yeah, it is a critical disclaimer for anyone managing their own money.
The sources explicitly warn, do not blindly trust market experts.
Oh, that's right.
And yes, that includes us synthesizing this data for you right now. Do not take a financial institution's Q4 price target as a guaranteed reality, and do not let a talking head's panic dictate your actions. We're just laying out the mechanics here.
Right. The 57,000 jobs miss, the dropping bond yields, the sovereign accumulation. We're explaining this so that you understand how the machine actually works.
The data provides you with a map of the terrain, but you are solely responsible for navigating it. You have to build a strategy that aligns with your own risk tolerance, not JP Morgan's.
Well said.
So let's lock in the key takeaways here. The June U.S. labor market showed profound weakness, printing barely half of the expected jobs and suffering massive downward revisions.
Which forced algorithms and institutions to rapidly price in Federal Reserve rate cuts.
Right, causing Treasury yields and the dollar to drop, which subsequently ignited a massive surge in precious metals.
However, gold is currently trapped below a major institutional sell wall at $4,200 an ounce.
Its ability to chew through that resistance will rely entirely on whether upcoming CPI and PCE reports show inflation cooling down or heating back up.
It is the very definition of a market holding its breath, balancing short-term data dependency against long-term structural accumulation.
And that leads to a final lingering thought I want to leave you with today. We spend immense amounts of time doing exactly what Wall Street does, obsessing over a single month's non-farm payroll data, agonizing over whether a central bank will tweak interest rates by a measly 25 basis points.
We hyper-focus on the micromechanics of the current system.
Exactly. We track minor fluctuations in the dollar index. But if the very institutions that issue fiat currency, global central banks, are quietly and relentlessly hoarding physical gold at record rates, seemingly immune to price or interest rate changes,
Right.
and if global debt has spiraled to levels that mathematically cannot be unwound, are we missing the forest for the trees here? Is our obsession with month-to-month U.S. economic data blinding us to a much larger historic shift in what the world will actually consider real money a decade from now?
Well, when the architects of the financial system are quietly changing the foundation of their own vaults, it is definitely worth asking if the daily data points even matter in the long run.
Something to think about as you review your own portfolio. Thank you for joining us on this deep dive into the global markets. Remember to hit that like button, subscribe, and leave a comment down below. Stay curious, keep questioning the consensus, and we will see you next time.